Welcome back. Today, we're diving into the top 10 tax deductions you're probably missing in the US. The tax code is designed to give you breaks, if you know where to look. These tips could save you a lot of money, so make sure to watch till the end. Let's kick things off by diving into a topic that could save you a significant amount of money. We're talking about the home office deduction, a valuable tax benefit for those who work from home. This deduction allows you to write off a portion of your home expenses, such as rent or mortgage interest, utilities, and property taxes. Even if your workspace isn't a dedicated room, you could still qualify if the space is used regularly and exclusively for work purposes. For example, if your home office takes up 10% of your living space, you could potentially deduct 10% of your home expenses. The IRS has simplified the home office deduction with an easy option, $5 per square foot, up to 300 square feet. So, for a 100 square foot home office, you could deduct a flat $500, making the process straightforward. It's crucial to keep accurate records of your expenses to ensure you can back up your claims. The potential savings from this deduction are well worth the effort, providing you with more financial flexibility. Trust me, it's worth looking into. Don't leave money on the table when you could be saving it. Next up, let's talk about student loans. Many graduates are burdened with student loan debt, but there are ways to ease this financial strain. You might be able to deduct a portion of the interest you paid on your student loans. There are eligibility criteria, your filing status, the amount of interest paid, and other factors. Not being claimed as a dependent and ensuring you meet the income requirements. Your modified adjusted gross income, MAGI, must be below a certain threshold to qualify for this deduction. For 2023, that threshold is $90,000 for single filers, which means if you earn less than this amount, you could be eligible, and $180,000 for those married filing jointly. This higher threshold provides more opportunities for couples to benefit. You can deduct up to $2,500 in student loan interest per year, which can significantly reduce your taxable income. This means if you paid $3,000 in interest, you can reduce your taxable income by $2,500, making a noticeable difference in your tax bill. However, you can't claim this deduction if you're using the standard deduction. It's important to know the rules to maximize your benefits. You'll need to itemize your deductions on Schedule A of Form 1040. This process might seem complex, but it can be worth the effort. If you have significant student loan interest and other itemized deductions, it could be well worth your while to go through this process. Don't leave free money on the table. Take advantage of every deduction available to you and ease your financial burden. Medical expenses can really put a dent in your budget. You can deduct medical expenses that exceed 7.5% of your adjusted gross income, AGI. For 2023, if your AGI is $100,000, you can deduct medical expenses that exceed $7,500. This deduction covers a wide range of medical expenses, including doctor's visits, hospital stays, prescription drugs, dental care, vision care, and health insurance premiums. Keep detailed records of all your medical expenses throughout the year. Save all receipts, invoices, and statements. Make sure the medical expenses are for you, your spouse, or your dependents. Claim this deduction if you're facing significant medical expenses. It could potentially save you thousands of dollars on your taxes. If you regularly donate to charity, pay attention to this deduction. Charitable giving not only helps those in need, but can also provide you with significant tax benefits. The charitable contributions deduction allows you to deduct donations to qualified organizations. This means that your generosity can directly reduce your taxable income. This includes charities, churches, educational institutions, and other non-profit organizations. Essentially, any group that is recognized as a non-profit by the IRS can qualify. You can only deduct donations that exceed 60% of your AGI. This limitation ensures that your deductions are in proportion to your income. Proper documentation is required for your donations. This means keeping detailed records of your contributions, including receipts and acknowledgement letters. For cash donations, have a bank record or a written acknowledgement from the charity. This documentation is crucial for substantiating your claims during tax filing. For non-cash donations like clothing or furniture, you'll need a receipt or other written acknowledgement. The value of these items must be assessed and documented accurately. The CARES Act allows taxpayers who take the standard deduction to claim an above-the-line deduction of up to $300 for cash contributions to qualifying charities. This is a special provision to encourage charitable giving. Deduct up to $300 in cash donations, even if you don't itemize your deductions. This can be a simple way to benefit from your generosity without complicated paperwork. Give back to your community and potentially reduce your tax liability. Your contributions can make a significant difference, both for those in need and for your own financial health. Let's talk about the state and local tax, SALT, deduction. This allows you to deduct state and local taxes you paid, including state income tax, property tax, and sales tax. The Tax Cuts and Jobs Act of 2017 capped the SALT deduction at $10,000 per household. Even if you paid more, you can only deduct up to $10,000 on your federal income tax return. Factor in this cap when calculating your potential tax savings. Attention all homeowners. The mortgage interest deduction allows you to deduct the interest you pay on your mortgage. You can only deduct the interest on the first $750,000 of your mortgage debt. You need to itemize your deductions on Schedule A of Form 1040 to claim this deduction. Even with these limitations, the mortgage interest deduction can be a significant tax break. For example, with a $500,000 mortgage at a 4% interest rate, you could potentially reduce your taxable income by $20,000. Combine the mortgage interest deduction with other deductions to maximize your tax savings. Make sure you're taking advantage of this valuable deduction. Let's talk about saving for retirement. You can get a tax break for contributing to a retirement account through the Retirement Savings Contributions Credit, also known as the Saver's Credit. This credit is designed for those with modest incomes and can be worth up to $1,000 for single filers and $2,000 for those married filing jointly. To qualify, you need to be at least 18 years old, not a student, and not claimed as a dependent. For 2023, the maximum retirement contribution that qualifies for the credit is $2,000 for individuals and $4,000 for married couples. File Form 8880 to claim the Saver's Credit. It's an extra incentive to save for retirement. To all the educators out there, this deduction is for you. The Educator Expenses Deduction allows eligible educators to deduct up to $300 of qualified expenses for classroom materials. This deduction is available to teachers in grades K through 12 who work at least 900 hours during the school year. $300 isn't much, but every little bit helps. It's a way for the government to show appreciation for the hard work and dedication of our educators. If you're an eligible educator, make sure you claim this deduction. It's a small way to acknowledge those extra efforts. Attention all freelancers, independent contractors, and small business owners. This deduction is for you. When you're self-employed, you're responsible for paying self-employment tax, which covers Social Security and Medicare taxes. The self-employment tax rate is 15.3%. You can deduct half of your self-employment tax on your federal income tax return. File Form 1040-ES to make estimated tax payments throughout the year. Deduct half of your self-employment tax on Schedule SE when you file your annual tax return. It's better to stay on top of your estimated tax payments than to get hit with a huge tax bill. Take advantage of this deduction to reduce your tax liability. Let's talk about health savings accounts, HSAs. An HSA is a tax-advantaged account that allows you to save for healthcare expenses. To be eligible, you need to be enrolled in a high-deductible health plan, HDHP. Contributions to an HSA are tax-deductible, reducing your taxable income. For 2023, the maximum contribution limit is $3,850 for individuals and $7,750 for families. Withdrawals for qualified medical expenses are tax-free. Save for healthcare expenses and reduce your tax liability with an HSA. Don't forget to subscribe for more money-saving tips. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more tips on personal finance and investing. Consult with a tax professional to make sure you're getting the most out of your deductions. See you in the next video.